Any way you look at it, today's auction for 30-year U.S. government bonds was an unmitigated disaster, and it's further proof that there is just not enough demand for U.S. government debt, at least not at these prices, which means prices need to fall and interest rates need to rise, and the stock market did not like today's results. What's up, guys? I'm Nobody Special, and before we get into just how bad the results of today's 30-year bond auction was, I want to set the table and talk about this relative euphoria that we've seen in the bond market since mid-last week. See, mid-last week, the quarterly refunding announcement came out from the Treasury Department when Secretary Janet Yellen here announced her plans to borrow only $112 billion this week. Now, the market had previously been terrified that she was going to borrow $114 billion this week, and well, that little $2 billion difference apparently was enough to send the bond market soaring as people started piling into long-duration U.S. government debt, saying the worst was behind us and a new bull market for bonds was here. That is, until today. And here we go, dated just today in Barron's, 30-year Treasury auction breaks bad and sinks stock market. The Treasury's auction of 30-year bonds on Thursday went about as bad as it could, indicating investor reluctance to own long-dated government securities. At the auction of government debt that matures in 30 years, investors were awarded 4.769% in yield, 0.051 percentage points higher than the yield in pre-auction trading. The difference between the two yields, called a tail, indicated a weak auction where the U.S. government had to entice investors with a premium over the market to buy their debt. And that right there is a massive understatement. That 5.1 basis point tail, that is the biggest tail ever recorded in a 30-year government auction. Now, the tail is the difference between the highest yield seen during the auction and the expected yield at the auction. And just to put that in perspective, yesterday's 10-year government bond auction that went pretty well saw just a 0.8 basis point tail. This one saw a 5.1 basis point tail. So the government had to lower the price of that bond until they found enough bidders to sell all the debt that they were issuing. Another indicator of how bad this auction was how much of this stuff that primary dealers had to take home. Primary dealers who buy up supply not taken by investors had to accept 24.7% of the debt on offer, more than double the 12% average for the past year. Primary dealers are mostly the big banks, the people who run these auctions, and whatever doesn't sell, the primary dealers have to take home. That's the price they pay for the privilege of collecting all the fees on these auctions. And today they had to take home almost a quarter of all the debt that was on auction because there just weren't enough buyers. Today's 30-year auction was very weak, wrote Ben Jeffrey, a strategist at BMO Capital Markets. The 30-year auction was part of the government's $112 billion debt sale and followed an uneventful 10-year auction on Wednesday. And again, that $112 billion number, there it is. Everybody was so optimistic about that when they got it last week, just because they were expecting 114, which means the amount of money that the government borrowed this week was only slightly better than absolutely terrible. And it sparked this massive rally in the bond market that saw a major drop in Treasury yields over the last week or so. And I've been saying on my morning live streams that the underlying weakness in the bond market, the fact that the government is issuing too much supply and there aren't enough buyers, that is unchanged. With the Fed still acting as a net seller of U.S. government debt because they're unwinding their balance sheet, otherwise known as quantitative tightening, and with countries like China and Japan, who have historically been big buyers of U.S. government debt, currently selling our debt, there just haven't been that many buyers in the market, and this is at a time when exploding government deficits are resulting in a huge amount of new bond supply hitting the market, which means lower bond prices and higher bond yields. Another reason why today's 30-year Treasury auction was an unmitigated disaster is something called the bid-to-cover ratio. Now, that measures the total number of bids in the auction versus the total amount of government bonds that were sold at the auction. And as you can see all the way over there on this chart, the bid-to-cover ratio in today's auction was 2.24. That means there was $2.24 of bids for every $1 in bonds that was auctioned off. And while that may seem like a healthy appetite for U.S. government debt, you have to look at the comparable months. That's down from the last auction a month ago that saw about 2.46 in the bid-to-cover ratio. And it's also the lowest that we've seen since right here, December of 2021. This is another indicator that appetite for U.S. government debt is waning at a time when the supply of U.S. government debt is rising. And you can see that 30-year auction on virtually every important chart in the market today. Here we go, right at 1 p.m. Eastern time today. There's your 30-year government bond auction. And all of a sudden, yields right here, this is the 30-year Treasury yield. You can see a big step change up. It ended up closing the day at 4.777%. That is almost 16 basis points higher. Again, the relationship between bond prices and bond yields. If you're seeing these yields going higher, you're seeing those bonds go lower. The price of 30-year U.S. government bonds took a dive today. And it wasn't just the 30-year U.S. Treasury that was affected by this. You can also see it here on the all-important chart of the U.S. 10-year Treasury. A big move up right here at 1300, 1 p.m. Eastern time. Right as those 30-year bond auction results were announced, the 10-year Treasury took a step change higher, ended up closing the day almost 14 basis points higher at 4.634%. And stocks didn't like it either. Check out the S&P 500 today, 1300 Eastern time. The S&P takes a dive, continues lower throughout the rest of the trading day, snapping an 8-day winning streak for the S&P 500, which closed down 35 points on the day. NASDAQ, same result right there, 1300, big step change down in the charts. NASDAQ ends up closing the day down 129 points, again snapping an 8-day winning streak. And you can even see it here in the DXY, or this is the strength of the US dollar versus other global currencies. At 1300, 1 p.m. Eastern time, the DXY takes a big step change up. Now it bounced around a little bit, came back down, ended up rising again, closing out the day 38 basis points higher, currently at 105.9. And speaking of some strange happenings in the bond market, check out this one that broke right around the same time as that 30-year bond auction result got announced. Ransomware attack on China's ICBC disrupts Treasury market trades. ICBC, that's the Industrial and Commercial Bank of China, one of the biggest banks in the world. Apparently there's been a hack there, and it's been disrupting their ability to trade U.S. Treasuries. Now, that was just announced today. No word about when the hack actually took place or how long the disruption was. And that's a little suspicious, isn't it? Especially considering some of the stories that we've seen in recent days. Recall we had the Japanese interbank payment settlement system went down a few weeks ago. That was supposedly due to a system upgrade. We had the ACH transfer system went down on Friday last week, preventing people from getting their direct deposits. That was supposedly due to one guy and his fat fingers messing up some data entry. Then Monday we had the Mr. Cooper hack. That's fun. 4.3 million people couldn't pay their mortgages. And now one of the largest banks in China is getting hacked and they can't participate in U.S. Treasury markets. Something is up with our strong and resilient financial system. But what do I know? I'm just a Twitter rando and a conspiracy theorist. I'm sure everything is fine. Oh, by the way, mortgage-backed securities is a mess. Till next time, live small and dream big.